So now I will explain the compare and evaluate the performance of top public and private sector banks from different perspectives. First, in terms of profitability and efficiency, we can see that the private sector banks perform more better than public sector banks because they have the higher net interest margin and return on asset compared with public sector banks. This showing that private sector banks have an advantage in asset utilization efficiency and profitability. In contrast, we can see that the public sector banks are more weaker than private sector banks because they play a significant role in inclusive finance and provide loan to priority sectors while serving a broader customer base. So this will driving up the operating costs and limiting their profitability. At the same time, their credit to deposit ratio remain below 80%, which consider they adopt a conservative lending strategy, while the private sector bank have higher credit to deposit ratio compared with public sector bank. So they are more aggressive in credit expansion. So this will driving up the interest income growth and further enhance the overall profitability. Besides that, the private sector bank also have highest capital adequacy ratio. So this will enhance the ability of private sector bank to manage their risk and support their future growth. So based on the above analysis, we can see that the private sector bank have stronger performance than public sector bank. So that's all for my part.
So, how do you think factors influencing CASA levels in Indian bank?
Okay, so CASA levels in Indian banks are influenced by several factors. So CASA is current accounts plus savings accounts. Okay, so for the first factor is interest rate movements. Okay, during high interest rate periods, many customers move their money from low interest saving account to higher yield deposit or mutual funds. Okay, second, digital competition has intensified. Okay, private bank and small finance bank offer easy digital onboarding, higher saving account interest, and better app experiences. Okay, so that many public sector banks always have bad app experiences and sometimes they are outdated. Okay, for the lastly, I would say that customer behavior has changed. People prefer investing in mutual funds, system investment plan, and stock market instead of putting too much money in saving account. So all these factors explain why CASA ratios across many Indian banks have been declining. Okay, so can you explain or examine credit deposit ratio and CASA ratios, trend of top public and private sector banks in India, and discuss whether CASA can impact the financial stability of the bank?
In recent years, the credit growth in Indian banks has been faster than deposit growth. Because of this, the credit deposit ratio increased to about 80% in March 2024. This means the banks lending out most of their deposits they collect. As a result, their liquidity become tighter and they depend more on costly borrowings. At the same time, the CASA ratios are declining, especially in the public sector banks. In February 2024, the average CASA ratio in the banking sector was 40.5%, but many public banks were below this level. Some private banks perform better because they have strong digital platforms and better customer services. This shows that technology and customer experience helps banks to attract more CASA deposits. So does CASA affect the bank's financial stability? Yes. CASA deposits are cheap and stable. When CASA decreases, the bank must use more expensive fixed deposits and borrowings. This raises their cost of funds and reduces profit margin. It also creates a liquidity risk during difficult market conditions. The case clearly shows this problem at Union Bank, where the CASA fell to 33.58%, much lower than the industry average. This led to higher funding cost and pressure on the bank's performances. That's all for me.
So can you evaluate the performance of Union Bank of India and compare its performance with other public and private sector banks in India? And can you also explain the probable cause of the decline in CASA ratio of Union Bank?
Okay, thank you. So basically, Union Bank of India's CASA ratio has improved to about 38% in 2024, showing that they have better growth in low-cost deposits from 2020 to 2024. So, but however, compared to public sector banks like SBI and Bank of Baroda, Union Bank's CASA ratio is slightly lower, as these banks record around 40% or more. For private sector banks, perform the best with CASA ratio between 40 to 50% due to stronger digital banking and customer outreach. Overall, Union Bank is improving, but it still lags behind both public and private sector banks. So why CASA ratios of Union Bank is declining? One of the reasons is competition that has occurred because small finance bank offers higher savings interest rates, which is over 25% for borrowers and above 8% for savers. Next is digital banking plays a role too, because the VYOM app from Union Bank was underachieving compared to public and private sectors. Lastly, we also see slower growth in current account deposits, where private banks tend to manage their customer relationship better.
Okay, can you recommend action plans for the Union Bank of India to improve its CASA?
Yeah, sure. Here are the recommended actions for Union Bank India. So there are three which I have. So the first one is they must accelerate the acquisition for the launching targeted digital savings. So it will help their current accounts for youth and MSMEC. So while leveraging the rural branches also. So for more quality and this one. Okay. For next, the Union Bank, they should improve their online bankings. Yeah, so like how in Malaysia, so they have to engage digitalize our banking system as well, so to cross-sell CASA and also existing customers to radically improve the mobile apps. So last but not least, they have to foster ecosystem partnerships where it becomes the embed banking choice by the partnering with fintechs and corporates and also government platforms branding UBI as well. And that's all from me.
That's all for us.
Thank you for watching our podcast.
Bye.